at the balance sheet, we were to look at the balance sheet. So that is where I want us to pick up from. And of course, there are past paper questions which I've been able to share on the group. So hope you can be able to access them because the question we were looking at was from it was from June 2011. It is from June 2011. It was question number 2, June 2011, question number 2. So if you can be able to open that particular paper, June 2011, question number 2, let me know whether you've been able to open it. Whether you've been able to open it. There's the remaining bit you are supposed to look at the balance sheet. The balance sheet. So just confirm there in the chat whether you've been able to access it. Whether you've been able to access it. Whether you've been able to access it. If it is urgent, you'll also So I can see Ruben says sound, please. Sound, please. I think you should be able to hear me. You should be able to hear me. So there's a question we were looking at. We have to look at this, the final part, which was the balance sheet for that particular question. So you can open it. It was June 2011, question number 2. It is on the past papers, which I've been able to share on the group and hope you can be able to access them. So have you been able to access it? June 2011, question number 2. June 2011, question number 2. We were supposed to look at the balance sheet. So the question was on SH and company. SH and company. SH and company statements. Supposed to get the statements. Statements of financial position. Statement of financial position. Statement of financial position. Statement of financial position as at that is the 31st of December 2010. 31st of December 2010. So we'll have in this case our shillings. So our shillings is actually in thousands. Our shillings will be in thousands. Our shillings will be in thousands. And of course, as per any other balance sheet or statement of financial position, so still the same case, when you are preparing a statement of financial position for professional firms, you'll start with what we call the assets. Of course, now in this case, we'll start with the assets. We can start with the non-current asset. Non-current assets. Non-current assets. Non-current assets. So if you look at in the balance sheet, you look at, for example, what had actually been presented there. So we had office equipment. If you look at the trio balance, we had office equipment. Office equipment. Office equipment. So the cost there was actually 1840. But remember, we had actually calculated depreciation for this particular equipment. What was the depreciation for the equipment? The one we calculated, the depreciation for equipment was how much? The one we calculated, it was how much? The depreciation for equipment was how much? The depreciation for equipment was how much? We had calculated the depreciation in the question when we were solving it the previous time. I don't know. It was how much the depreciation for equipment? For equipment. So we have office equipment. We have, in this case, furniture. We have fixtures and furniture. Fixtures and furniture. Fixtures and furniture. So fixtures and furniture, it is 805, 805. But of course, you also had the depreciation. We calculated depreciation. So on fixtures and furnitures. Then also in this case, you have library books, which you said will still be part of the non-current assets. So it was 644, 644, 644. But I think there were some books which were acquired. So the total was coming to 1,010. Then another asset we have in this case is what was acquired during the year was actually office premises. Office premises, which the value was 6,500,000. 6,500,000, but it had a depreciation. So the depreciation for the office equipment, if you can remember, it was 184. For the fixtures and furniture, we had computed, it was 120.75. For the library books, we also, in this case, looked at the depreciation. It was actually 126.5, 126.50. Then in this case, we had for the office premises was 162.5, so 162,500. So these were the non-current assets. But now in this case, you also have the current assets. Current assets. So the current assets in this case, you'd put work in progress. So the work in progress that they were having to undertake for their clients before the year came to an end. So these advocates, the work they were having to undertake for the clients before the year came to an end, it will be part of what the current assets. And of course, this one was actually provided. If you look at note number 13, representing the client's work was work in progress as of 31st of December, which was in this case what 1170,000. So work in progress at the end of the year. Work in progress at the end of the year. Work in progress at the end of the year. So that was actually 1170. Then also in this case, we have debtors and disbursements. So there's a figure we calculated in the debtors and the disbursements. So that is still a current asset, debtors and the disbursements. The figure we calculated in the debtors and disbursements was a balancing figure. The balancing figure for debtors and the disbursements. There was a balancing figure for debtors and the disbursements. There's a balancing figure for debtors and disbursements that we calculated in our previous class. So I think we had done it in the previous class. There was a balancing figure for debtors. It was 4,009,000. Then of course, in this case, we have the balances we had actually computed. You remember in the cash book, the balances in the cash book. So in this case, we have the amount in the bank, with regard to the client, and of course the office. So the amount for the client in the bank, the one that we had actually computed, what were we getting? It was for the client, it was actually 905. And of course, for the office was how much? For the office was how much? It was 1014. It was actually 1014. So if you get the difference here, you should be able to get 1656. So this is the fixtures and furnitures you left. Remember, these ones you had computed. We had actually computed them. So if you can check our working for depreciation, you'll get these figures. So you less, so that in this case, you can be able to get the net book value by the end of the year. So in this case, you get 684.25. Then in this case, it will be 883. This one will be 883.75. Then this one, you should be able to get 663. 6337.50. So this will encompass our non-current assets and of course what current assets. There's something I told you must be able to note with the professional firms. The library books, you must be wondering, they are non-current assets. They are non-current what assets. So the library books will be taken to be what? To be non-current what assets. To be non-current assets. So these are the only, in this case, assets you have. So what is the total you're having to get in terms of the assets? What is the total you're having to get in terms of the assets? The total you're having to get in terms of the assets? The total you're having to get in terms of the assets. What is the total figure? The total figure. Using your calculator, the total figure. The total figure. It is 16629.5. Any other person who has made the addition? Any other person who has made the addition? One 29.5. It is supposed to be 166,659. 166. This one from Icapel, 16659.5. So you can confirm confirm what you might have missed out. So check your figures, This is actually the correct figure. The correct figure you are supposed to be able to get. The correct figure you are supposed to be able to get. Then in this case, we have the other side. That is, of course, now in this case, the capital and liabilities. The capital and liabilities. For these kind of firms, we don't have equity. So they don't sell shares. So that in this case, they can be able to, for example, raise equity. So we don't call it equity and liability, but we refer to it as what? Capital and liability. So the other side of the balance sheet, in this case, we'll be able to have the capital and liabilities. 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 Capital and liabilities. Capital and liabilities. So in this case, if you look at the question in this case itself, you've been told that the capital up there in the trio balance. So the capital they started the business or they had in the business was actually in this case, we have shillings in thousands. It was actually 4140. So this one is actually in the trio balance. Then in this case, we have the profits. We have the profits that were realized. Profits that were realized in the income statement that you actually computed. So the profits realized, they were how much? Profits realized in the income statement, they were how much? Profits realized in the income statement we had actually prepared. The profits that were realized in the income statement that we had actually prepared. It was 1143.5, 1143.50. But remember, during the year, they had actually made some kind of drawings from the business. If you look at note number 9, they had made drawings from the business. Note number 9, they had made drawings from the business, whereby in this case, you're having to be told the partners withdrew 1750,000 from the bank. So they had actually drawn out some money from the business. So that was actually how much? 1750. 1750. So 1750. So this one, basically, it was actually drawings from the business. So you'll end up having to less. You'll end up having to do what? To less the drawings. So what are you having to get as the total capital there? The total capital in this case. So of course, now in this case, you have the non-current liabilities. Non-current liabilities. One of them is the mortgage. If you can remember, there was a mortgage they had actually taken up. So the mortgage, if you look at note number 11, there was a mortgage whereby they were buying office premises. They paid 3 million in cash. but there was the balance which they ended up having to take what? A mortgage. A mortgage is simply what? A loan. So there's that mortgage, which is actually how much? 3.5 million. So 3.5 million is actually 3.5 million. So 3.5 million. Then still the same case. In this case, we have a loan from the bank. A loan from the bank. A loan from the bank. So we had a loan from the bank. A loan from the bank. But they ended up having to pay 550 of these loans. So the loan from the bank, if you look at the trio balance, loan from the bank, it was actually is the last item in the trio balance, 1450. But in this case, they ended up having to pay 550. Remember in our cash book, so they paid 550. So this one you're having to get is 35, 33.5, 35, 33.5. So this one they had paid 550. So there was a repayment which they made of 550. 550. So that means in this case, the loan here was actually 900 as a long-term liability. As a long-term what? Liability. If you look at note number 6, they had made a repayment of 550. A repayment of 550. They had made a repayment of 550, so that is 900. So that basically encompasses our long-term liabilities, our long-term liabilities, our long-term liabilities. Then in this case, you have the current liabilities, current liabilities, current liabilities. If you look at the trio balance, part of the current liabilities, in this case, we have the accounts payable, accounts payable. If you look at the trio balance, in this case, you have the accounts payable, accounts payable, accounts payable of 378, 378. Then you have in this case the client account. Remember in this case we had come up with the client account and there was a balancing figure in the client account. So this simply basically means is the money that we are having but does not belong to us. It belongs to the client. Remember in this case we said the firm will open 2 bank accounts, the one of their own and another one in this case will be belonging to what? To the client. So that money we are holding is not ours. It is a liability. In this case, for example, if we end our agreement between us and the client, we'll have to reimburse them that money. So if you can remember, we opened a client account in our workings and there was a balancing figure in the client account. So what was the balancing figure in that client account? In the client account, what was the balancing figure in the client account? It was 905. 905. If you can be able to recall, we prepared it. It was actually 905. So that would be part of what the current liabilities. Because this money does not belong to the firm. It belongs to the client. So it is a liability. If they end an agreement today that this client will no longer be their client, they'll reimburse him all this money. It does belong to what? To the client. Then in this case, we have the accruals or outstanding amounts. The accruals, in this case, you can be able to see them in the trio balance. We have the accruals. Accruals, these are simply amounts which have not actually been paid by the end of the year. So you're having to be told they were how much? 253. 253,000. 253,000. Then also we had mortgage interest. Mortgage interest, as per note 11, acquired office premises of these, the balance was financed through a mortgage which attracts interest rate at 12% per annum. So this interest was not actually had not actually been settled. So accrued interest on the mortgage, interest on the mortgage, accrued interest on the mortgage, accrued interest on the mortgage. And of course, now in this case, we had actually done a working of this particular mortgage interest, and it was actually coming to 420. So this one had not actually been settled by the end of the year. So it becomes a current what liability, still be part of the liabilities in this case. Then in this case, you have what? The accrued expenses. So the accrued expenses, that is in note number 8. Incur the following expenses which had not been paid by the end of the year. You have the accrued expenses. Accrued expenses, those ones you just add them directly. So they were not actually paid by the end of the year. If you look at note number, that is note number 8. So we have in this case 3,400 plus that is 1,650 plus that is 1,720. I think you'll be able to get something like 677 So this one, I think you are getting, it's 4,400. What about here? When you add, what is the figure you're having to get? The current liabilities. The current liabilities. The current liabilities, you're getting how much? The total. So 378, 905, 253, 426, 770. You're getting how much? 8726. 8726. 8726. So 8726. So what is the total? What is the total if you add the capital and liabilities? The total if you add the capital and liabilities. The total if you add the capital and liabilities. Opti, you've given the correct figure because someone else has not confirmed. Opti, you've been able to give the correct figure. What is the total if you add all of them? The total if you add all of them? 16,659.50. And of course, it should be able to balance with what we got under the capital, under the assets, So 16,659. So 16,659.50. So that basically becomes what our balance sheet for S and H becomes our balance sheet for S and H. So that is really how you come up with what the balance sheets. You come up with the balance sheets for the professional firm. So I want us to look at another question, which I had also left as an assignment. It is November 2018, question number 5B. So confirm whether you can be able to access it, because I had also shared the past paper, because I want us to move together. So November 2018, question number 5B. November 2018, question number 5B. So confirm whether you can be able to access it. November 2018, question number 5. I can see Capel says yes. At least 2 or 3 people should be able to confirm. 2 or 3 people should be able to confirm they can be able to access that past paper. You are far much better off if you print the past papers and you have them. So it is quite easy. When we are in class, we say refer to a past paper, you just open it very fast. You just open it very fast and it becomes very easy. You just open it very fast and it becomes very easy. It becomes very easy. It becomes very easy. So I can see Ruben says yes. So November 2018, question number 5B. What about the rest? Should I at least be able to confirm you can be able to access it? Because I want us to move together. So the question says, the question reads, I can see T says yes. November 2018, question number 5B. So the question reads, I'll be able to go through it very fast. The following TO balance was extracted from the books of DD Associates, a firm of advocates, as at of 30th September 2018. So the first item we're having to be told, cost charged to clients. You have civil cases, criminal cases, oath, conveyance fees, and preparation of wills. So all these one will actually be incomes for this particular firm. So that is what they charged. Then cases in progress as at the start of the year. So that is actually what 11,04,000. Client's account, money held on behalf of the clients. So that is what you're having to say is a liability. It's not your money. You're just holding it on behalf of what the client. So it will be a liability in the balance sheet. Accounts payable is a liability. Accounts receivable, you know, that is what an asset. General office expenses is an expense they incurred. Furniture, fixtures, and library books, those are what? Non-current assets. Cash at bank, we have the client account and of course the office account. So in this case, it was exactly what 1671, that is an asset. Capital is what they had as capital. Disbursements on behalf of what? The client. That is an asset. Is money they disbursed on behalf of the client. So the client didn't have the money in his or her own account. So they disbursed on his behalf. but of course, you'll be able to pay them back. So that is an asset or like a debtor. Drawings is money they drew from the business. So that basically reduces the capital. Salaries to office staff, an expense. Rent and rates is an expense. Postage and telephone expense, printing and stationery, what expense? It is estimated that debts amounting to 165,000 might not be collected and should be written off. So that is basically bad debts to be written off, reduces what? The debtors account. Depreciation should be provided at the rate of 20% per annum on the book value of furniture, fittings, and library books. Cases in progress by the end of the year were valued at what? 705. So this will enable us to determine how much was actually the income, realized by this particular farm. So they want us to prepare, in this case, the statement of comprehensive income for the year ended 30th of September 2018, and of course the statement of financial position as of 30th of September 2018, as of 30th of September 2018. So we can be able to start off by looking at the income statement. So DD Associates, it is actually DD Associates, DD Associates, DD Associates, income statement for year ended 30th of September, that is 2018. Is it 2018? I think 2018, yeah, exactly 2018, 30th of September 2018. So of course, as per the normal format of an income statement, you'll start with what? The incomes. And remember now, in this case, our figures will likely be in thousands. So they'll be in thousands. So you'll start with the incomes. What this firm of advocates was realizing as an income. So of course, in this case, as per the TRIO balance, you can be able to see that the cost charged to clients, you have, in this case, the first income they realized is what they were charging their clients, cost charged to clients. And of course, in this case, you can be able to see from the TRIO balance, we had civil cases, that is 4220. So we had civil cases, that is 4220. 42 is supposed to be 4250. 4250 plus. In this case, also we had criminal cases, 2450. 2450 plus. Also, we had, in this case, oath. There were some oath. People were taking some oath, and of course, they are farmed for them. So that is 260. Conveyancing fee. Maybe they were transferring properties like land on behalf of their clients. So that was 340,000. They also did what? Preparation of wills. So people were preparing wills and they were doing for them. So they had charged that particular kind of a fee. So what are you getting as the total there? So of course, now in this case, there was some work which they had actually commenced at the start of the year. So that basically will still be part of their income in this current year. So you can add work in progress, add the work in progress they had actually commenced, add work in progress at the end, then you less work in progress, which was for the previous year, work in progress at start. This basically, for example, maybe they were doing conveyancing, but maybe it goes to the other year. Or maybe in this case, they were doing conveyancing, but it was for the previous year. So it doesn't basically count as part of the income for this year. So you'll have to remove. For example, that income that was supposed to be for the previous year, you'll end up having to do what? To remove. You'll end up having to remove at the start. The one that they had already commenced, but of course they realized the income the coming year, you'll have to add. For example, they have already sealed a deal in this current year to do conveyancing of property for a client, which is worth what? 705,000. But of course, they won't realize that income in the current year. But of course, it is still part of what they have been able to make as a transaction in this year. So you'll be able to add the work in progress they had actually commenced in the current year which maybe eventually will be paid by the coming year. So at the end, what was the kind of work they were having to do that in this case, they haven't yet completed, but it's still part of what they are supposed to be paid this year. So it is the income for this what year. If it's work in progress at the start, it means this kind of deals they'd sold the previous year. So they'd already, for example, recognized this income in the previous year. So you have to do what? To remove it. You have to remove it. And of course, at the end of the year, this was actually how much? 705. This is actually in the additional information, which is the last item there. Then if you look at the TO balance, cases in progress at the start of the year, it was actually how much? That is 1104. It was actually 1104. 1104. So 11, this is 705, then 1104. So this one you are saying you do what? You less. What is the total you got here? It was 7,500,000. So 7,500,000. 7,500,000. So you can look whether in this case you have any other income. And of course, in this case, the income most obviously will be on the credit side of what? The TO balance. All incomes are normally the credit side of what? Of the TO balance. So you can look at any other item. If you look at these items, plans, account money, that is a liability. Accounts payable, liability. Capital is not part of the incomes. So it seems like in this case, we do not have any other income. So this basically gives us our net fees received or net fees they received, net fees they had received. So I don't know how much you are getting there. Then of course, in this case, we have the expenses. We have the expenses. We have the expenses. We have the expenses. The expenses. So the expenses, you are far much better off in this case. For example, if you start looking at the additional information. So in this case, we are told in the additional information number 1, it is estimated that debt amounting to 165,000 might not be collected and should be written off. So that is an expense. So bad debt written off. From that is additional information number 1. Bad debt. It is very direct. Bad debt written off. That was how much? 165,000. Then of course you are told depreciation should be provided at the rate of 20% per annum on the book value of furniture, fittings, and what? Library books. So depreciation, that is on furniture, books, and of course what? Furniture, books, and of course what? Fittings, and fittings, and of course fittings. It is supposed to be at 20% of the net book value. So in this case, if you look at our TO balance, the furniture, fittings, and library books was actually 1350,000. So you'll be able to multiply with 1350. So what are you getting for that particular kind of an expense? 20% of 1350, which is the net book value, because that is the rate at which they are providing depreciation. That is 270. So that is actually 270. 270. So of course, in this case, we are done with the additional information because the last additional information, we've already been able to use it here. We've already been able to use it here. So now in this case, you can look at the TO balance whether you have any other expenses. So we have in this case accounts payable. So accounts receivable is an asset. General office expenses. So general office expenses from the TO balance. In this case, it is actually 255. 255. Then in this case, also we have cash at bank, that is an asset. Furniture, an asset. Capital. Disbursements on behalf of the client, that is an asset. Drawings will affect capital. Salaries to office staff. Salaries to office staff. Salaries to office staff. That was 2160. 2160. Another expense, rent and rates. Rent and rates. Rent and rates. It was in this case 1800. 1800 or 1.8 million. Postage and telephone. Postage and telephone. Postage and telephone. That is 546. 546. Then in this case, you have the last one, printing and stationery is still an expense. Printing and stationery is still an expense. So that was in this case 1050. It was actually 1050. So I don't know, what are you getting as the total here? First of all, the total here is how much? The total there is how much? It is 7101. So 7101. Then the total here of the expenses, total there of expenses, the total of expenses, 6246. As you are saying 6246. What is the net profit? Net profit. What is the net profit? So of course the net profit, you get the difference. The incomes, you less the expenses. The incomes, you less the expenses. So the net profit comes to how much? It comes to how much? I can see T says 855. So hope it is correct. I hope it is correct. I hope it is correct, Ikapel. I hope it is correct. I hope it is correct. That is what the net profit that was realized by this what firm. So remember, this net profits will be part of what? The capital. So you'll transfer it to the balance sheet as part of what? The capital. As part of what? The capital. So the second part of the question in this case wanted us to prepare what? The statement of financial position. Statement of financial what? Position. So this, the income statement is done and dusted. Done and dusted. So we now in this case have to do what? Consider preparing what? The statement of financial position. So hope you've been able to clear up with this, because I want us to look at the statement of what? Financial position for DD Associates. Statement of financial position for DD Associates. Statement of financial position for DD Associates. Statement of financial position for DD Associates. So the statement, DD Associates statement of financial position as at statement of financial position as at the year end was actually 30th of September. 30th of September 2018. And most obviously in this case, we start with what? We start with the non-current assets. We start with the non-current assets. We start with the non-current assets. Non-current assets. So you'll have probably in this case, you can do your shillings here in thousands also. Your shillings in thousands like that. So we can start with the non-current assets. Non-current assets and current assets. So as per our TO balance, in this case, we have in this case furniture, fittings and library books. Furniture, fittings and library books. It was actually how much as per the TO balance? We have in this case furniture, fittings and library books. It was 1350. So we have in this case furniture. So the first one is furniture, fittings, and library books. Furniture, fittings, and library books. So, of course, you're having to be told it was actually 1350, but remember, these ones were depreciated. So they were, what was the depreciation amount? They were depreciated. What was the depreciation amount? 270. So someone is saying 270. 270. So what is the difference? 270. So if you less 270, what's the difference? What is the difference? What is it? The net book value is actually 1080. Is actually 10 is correct. It is 1080. So remember, in this case, the assets always will be on the debit side of what of the trio balance. So you must actually always, in this case, go back to the question and of course peruse the trio balance. On the debit side, are you seeing any other assets, non-current assets? There's none. There's none. There's only furniture, fittings, and what? Library books. So now in this case, we can be able to go to what? To the current assets. To the current assets. So now we can go to the current. Always the assets are normally on the debit side of what? Of the trio balance. So that's where you start from. So you can go to the trio balance and of course try to check whether we have any debits regarding, in this case, what? Current assets. Current. So you have the first one. We have the first one, in this case, disbursements on behalf of what? The client. So that is where disbursements on behalf of the client. Then we have the cash at bank. And of course, in this case, we have in this case for the client account and of course for the office. For the client account and of course what? For the office. So the cash at bank, We have the cash at bank. Cash at bank, the money they had in the bank. So you have in this case amount relating to the client, and of course the amount relating to the office. The office. So for the client in this case, we have 744. 744, and of course for the office you have 1671. Then you have disbursements on behalf of the client. What they mean by disbursements on behalf of the client is money they paid on behalf of the client, but of course this money they'll be able to recoup it back from the client. Disbursements on behalf of what? The client. What do you mean by this? The client account, these are client accounts here. There's a point in time haikuwa na pesa mingi. So there's a transaction they undertook on his behalf. What, how much? 360. So they'll pay him back. And of course, now in this case, that client becomes like what? A debtor. That's why we recognize it as what? As an asset. So it was actually how much? 360. So watakuja mulipa. Watakuja lipa our DD associates. So the deni wanadai. So in this case is what? Is like an asset. Drawings is not part of an asset. Salaries to office staff, not an asset. Rent and rates, not an asset. We have in this case what? I think there's somewhere we have accounts receivable. Yes, we have accounts receivable. Accounts receivable. Accounts receivable. Accounts receivable. It was actually how much? It was 2440. But remember, kulikuwa na zile zilikuwa written off ambazo walisema probably they won't be able to recover them. So it was how much? 165. You can remember bad debt written off. Bad debt written off. The bad debt written off. You have to write them off. So how much are you getting? When you write them off, how much are you getting? When you write them off, how much are you getting as the figure for receivables? The receivable is same as debtors. Accounts receivable is same as debtors. How much are you getting? So I can see someone says 2275. Hope it is correct. 2275. It is 2275. Then in this case, we have the cases or the matters that were actually in progress by the end of the year. So you have in this case the work in progress, cases in progress. Cases in progress by the end of the year become what? An asset at the end. Cases in progress at the end, that's additional information number 3. So that becomes what? So that is basically what they expecting out of their income the coming year. Out of their income the coming year. In this case, we have cases in progress, cash at bank, the cash at bank. Cash at, what are you getting of the total? What are you getting the total of the current? So those are the big current assets that we have. I think it is 6835. First of all, the current here. So Hope says 835. Is it correct? 35 is 5. 57. 57. 55. Then when you add when you add 5 as 1080, 755 plus 10, you get how much? 68. 35. So that would be on the side of what? That would be side of that is on the side of side and liabilities. So we have capital and liabilities, capital and liabilities. So capital and liabilities. So if we look at the trio balance, we've been given capital, the capital that was actually injected in this business. It is how much? The capital injected in this business is how much from the trio balance? The capital injected in this business in the trio balance is how much? In the trio balance, from the trio balance, the capital injected in this business is how much? 6220. 6220. You have in this case 6220. But remember, there's somewhere you're having to be told there were some drawings which were made. Still from the trio balance, there were some drawings which were made. So less drawings, less drawings, which were how much? But remember, we'll have to add the net profits, the profit realized by this particular farm. So the drawings were actually 1880. I think it's 1800 or 1880. Is 1800? Yes, 1800. 1800. What about in this case the net profit we realized? We also have to add it as part of what? The capital. Because if they didn't distribute this particular profit, it will basically be utilized as what? As the capital of the business. They'll still use it to expand the business. So in this case, it means that you have to do what? To add it. To add it. So it was actually how much? 855. Huh? 855. So that basically gives you what? The capital, the total capital. The total capital there. The total capital there. The total capital there. You'll be able to get it. It is how much? 52? Supposed to be 52.75 or something. How much is the total when you do the computation? So you less the drawings, then you add that one. 52.75, exactly 52.75, exactly 52.75, 52.75. But now in this case, you have what? The liabilities. So the liabilities always be or will be on the credit side, will actually always be on the credit side of the trio balance. So you'll have to go back to your trio balance and try to look at the credit side. You can see the client account money held on behalf of the client is 744. And of course, you have the accounts payable. The accounts payable is actually 816. Is there any other entry on the credit side which can look like a liability? No, there isn't. So there are only what? Two liabilities. So in this case, for the case of the liabilities, which are current, so they are current liabilities. The current liabilities, if you look at the trio balance, we have the money they had held on behalf of what? Of the client, which is not their money. So money on behalf of the client, money on behalf of the client. So from the trio balance, in this case, it is 744. 744. Then we have in this case the accounts payable. Accounts payable, these are creditors. Accounts payable, which comes to how much? In this case, it is actually 816. 816. What are you getting as the total? When you total this plus the current liabilities, remember in this case, kwa kitabu yako unaendelea, so usiende uandike kando. Don't write it separate. It's only that I don't have enough space to continue. So you write here current liabilities, then you continue with this one, then you place the figures in this column. How much are you getting? The total it says 6835. Eden, is it true? Eden, is it true? 6835. Is it true? 6835. 6835. Mumbi, is it true? 6835. Is it 6835? Yeah, 6835. So can be able to take it okay. Balance. Okay. So that is the statement of financial position. So that's why in this case you do what you prepare. In this case, you do what you prepare. For financial position and statement of comprehensive income. In this case, regarding what? Advocates. So the examiner really likes advocates. And of course, there's another question. You can be able to try to attempt it. It's just the same approach. Just the same approach in this case. It is August 2022 question number 4. That one you can be able to attempt as your own assignments. August 2022. August 2022, question number 4B. So you can be able to attempt that one at your own. Take up the same approach as this. Just similar. Yes. That one. Attempt. So I don't know if the others are having a challenge. So am I audible? Am I audible? It's my network. Check your sound system. There are a lot of what echoes. There are a lot of what echoes. There are a lot of echoes. So let me check on it. Let me check on it. So in the meantime, you can write this one as the heading of the topic we are going to start on, which we are starting on very quickly. Very quickly, we are going to start on this one. We are going to start on this one. You're going to start on this one. As I check on the sounds, we can start on another area. We can start on another area. So we are going to look at, you can write public sector accounting, public sector accounting. So public sector accounting, public sector accounting. So let me check on the sound just in a few minutes. Acha niwaulize kama iko sawa. What about right now? So is the echo still on or it's a bit better? So please try to confirm whether the echo is still on. I can see Capel says it is now okay. Iko sawa, iko sawa, iko sawa, iko sawa. Gitonga says clear, So we can start looking on public sector accounting, public sector accounting, public sector accounting, public sector accounting. So what is public sector accounting? So public sector accounting involves accounting for public sector entities. So you can be able to write something. It involves accounting for public. It involves accounting for public sector entities. It involves accounting for public sector entities. E.g., you can give an example of these public sector entities. You can talk about maybe parastatals, government agencies, government agencies, public schools, schools or entities, public schools, or in general, just what entities, etc. So these are what you call what public sector entities. And of course, in this case, they are public sector entities because the public has an interest in what they're having to do. The public has an interest in what they're having to do because majorly they are normally funded by the taxpayers' money. So they become what public sector what entities. So there's a way in this case, they actually prepare their accounts compared to what? To the profit-making entities. To the profit-making what? Entities. So there are different methods in this case they'll be able to deploy. But of course, before you look at the different methods, just note that in this case, when these public sector entities are preparing their books of accounts, they'll, in this case, utilize what we call what IPSAs, International Public Sector Accounting what standards. So for public sector entities, they have special standards or framework they must be able to observe. Remember, for the other entities, we've been talking more about what in this case, for example, IFRS, or maybe international accounting what standards. But for public sector entities, they'll be able to deploy what you call what IPSAs. So these IPSAs, it is a framework that has actually been developed to specifically, for example, guide us to how any entities that are basically involved as a public sector entity, they can be able to, for example, follow and be able to do what? Prepare their books of accounts. So they are regulated. Their preparation of financial statements, for public sector entities, for public sector entities, the preparation of financial statements for public sector entities is regulated under the IPSAs, or in bracket, you can be able to write in full and just say International Public Sector Accounting Standards. International. That is the International Public Sector Accounting Standards. International Public Sector Accounting what? Standards. International Public Sector Accounting Standards. So this is the framework. So we have a number of standards that have been developed in terms of IPSAs to guide, for example, each and every area. For example, if they are preparing the financial statements, how they can be able to go about it. So they'll deploy these one. They'll adapt these ones. For example, if you have school bazaars, if you have, for example, someone working in a government ministry, someone working in a government parastatal. So he'll be observing these ones as he does what? Prepares his books of what? Books of accounts, as he prepares his books of accounts. So in this case, there are key methods. So the key methods of accounting, there are key methods for accounting, in the public sector. There are key methods for accounting in the public sector. The key methods of accounting in the public sector. So they'll come out as we'll be preparing part of this particular financial statement. So number one, we have in this case what we call what? Cash basis accounting. Cash basis accounting. We have the cash basis accounting. Number two, we have what we call the accrual basis accounting. And then number three, they'll also in this case be able to, for example, ensure they undertake what we call what? Fund accounting. Then of course they prepare budgets. So there'll be an involvement of what we call what? Budgeting accounting. So they come up with budgets each and every time. You'll hear government is coming up with budgets. So there'll be an aspect of what we call what? Budgeting accounting, which you'll be able to see how it is actually normally done. They realize some kind of, for example, what they have been able to spend. They compare in this case with what they had set as a budget to realize, for example, what could be the variance or the deviation. When you talk about cash basis accounting, so this way now in this case, they'll end up having to record what they have been able to incur in terms of what an expense at that point in time. So is on cash basis. So in this case, it means that once they spend is when in this case they recognize, for example, what an expense. It's exactly what on cash basis. Or for example, once they realize an income in terms of cash is when they'll be able to recognize it in the books of accounts. So that is what cash basis. But accrual basis, in this case, you recognize an income, for example, when you've earned it before even you receive it. Or in this case, you recognize an expense at the point in time, for example, that expense has arisen even before you spend the money. Before you spend the money. That is the aspect of what? Of accrual. Like what we do in the normal accounting, that we recognize accruals at the end of the year as part of the expenses for the current year. This is what they mean by this case, what accrual accounting basis, whereby it is an income, you recognize it at the point in time it has been earned. Even if it will be paid in future, you have to recognize it in the books of accounts. That is what accrual. So you recognize income even before you do what you receive it. You recognize an expense, even in this case, for example, the outflow, sorry, is actually, for example, in this case, maybe undertaken, or you pay out that kind of an expense, you still don't do what? Recognize it in the books of account. For example, the accruals that we have to recognize them as part of the expenses in the current year. Even though we haven't paid for them, we'll pay next year. So the money will be paid next year. So in this case, you still recognize them as what? As accrual. It is opposite of the cash basis. For the cash basis, you only recognize an income once it is received. Style may deposit kwa account yako, pap, amu may receive the cash is like this, is when you recognize it in the books of accounts or in the financial statements. That is what the cash basis. So they can be able to adapt the two. But of course, now in this case, what you must be able to realize, the government agencies have been advised, I think from this particular year, they have been using what you're calling what the cash basis, but they have been called upon to adapt the accrual basis. The accrual what basis. So sometimes in this case, you've heard that probably counties are having what? A lot of outstanding amounts to their suppliers. And of course, in this case, if they ask about the pending bills, sometimes you hear the president has actually appointed a committee to look into all what the pending bills they want to pay. So what is the essence of appointing a committee to look into the pending bills? If, for example, if these agencies were preparing books of accounts, the reason is because they have ended up having to adapt to what this one cash basis, whereby, for example, if it's an expense, they'll only be able to recognize that expense in the books of accounts when there's an outflow or when it has been paid. But if they were using the accrual basis, it means that if expenses which they haven't yet paid, the pending bills which they haven't yet paid, they would be appearing in the books of accounts. So there's no need, for example, of appointing a committee. You just look at their books of accounts and be able to know, for example, County of Mombasa. If they are using accrual basis, it means that the amount outstanding to be paid, for example, in this case, to what? To the creditors, is this much. So those are the pending bills. Is there an essence of appointing a committee to look into it? You just add even the figures for each and every county. If they had adapted what? The accrual basis. But since they're using the cash basis, it means that those who made supplies, for example, to the counties, the only recognition is only what? The contract or the LPO. But their amounts are yet, in this case, for example, to be recognized in the books of accounts because they have adapted the cash basis. When that supplier will be paid is when, in this case, for example, they'll end up having to do what? Recognize that transaction under what? The cash basis. That's what I have to say in this case, for example, if it's under accrual basis, you recognize an expense even before the outflow is incurred by what? By the entity. You recognize an income once it is earned, even before it is received. So it will be part of what? The books of accounts. Books of accounts. I think in this case, in financial accounting, you must have learned about what? Accrual basis of accounting and cash basis of accounting. So that is basically what in this case can be adapted by these what? Agencies or government entities or public sector entities when they are doing what? They are accounting. Then of course, budgeting, as I've already been able to indicate, they normally prepare what we call what? Budgets. The government at the start of each and every year, they'll prepare what? A budget. Then of course, in this case, they'll, for example, look for means how they can be able to finance it. So during the year, they'll likely basically be spending. So they'll be able to compare what had been budgeted, the budget estimates, and of course, they compare with what? The actual expenditure. They'll compare with the actual expenditure. When they do this comparison, they realize, for example, there are what? Variances. variances, which in this case could be favorable, or in this case could be adverse. Could be adverse. And then in this case, at the end of it all, they'd be able to know, for example, how much was the net variance. And for example, what could have ended up having to cause them, maybe in this case, not them to be able to realize what they were supposed to realize as what? Maybe incomes to fund the budget, or what made them to end up having to spend more, even beyond what they, in this case, they had actually budgeted at the start of what? The year. So they end up having to, for example, do some kind of, like in this case, what you're calling what? Budgeting, accounting, budgeting, accounting. So we can be able to look at part of the differences between the public sector entities and, of course, what the other entities of the private sector entities. So the difference between public sector entities and private sector entities, you can be able to write differences between public sector entities and private sector entities. You can be able to write that the differences between public sector entities and private sector entities. Of course, in this case, you can be able to put this side public sector. You can use that table so that we can move a bit faster. So public sector, and then of course this side you can be able to put private sector entities. Private sector entities. What is the difference between the two? What is the difference between the two? So our first difference here, we can be able to look at it in the perspective of number one. In the perspective of number one, the objective. So what is the objective of public sector entities? In this case, they offer services to the members of the public. Their main objective is to offer services to the members of the public, They offer services to the members of the public. Then in this case, this other side, the main objective of private sector entities, they focus on making profits, to make or realize profits, That is their main objective. But for public sector entities, what you realize, the government forms them majorly, for example, to provide what? Essential services. For example, if it's a public school, in this case, it is to do what? Provide education to Kenyan citizens. If it's a public school, to provide what? Education to Kenyan what? Citizens. And then another difference, we can be able to look at it in the perspective of, in this case, ownership of this. They are owned by the government. These ones are owned by the government. They are owned by the government. Or sometimes in this case, we can have a public interest or the general public. They are owned by the government or the general public. Then these other ones, they are owned by investors. Who in this case are just what? Private citizens, investors, or shareholders. They are owned by investors or shareholders. Then in this case, another difference, we can be able to look at it in the perspective of funding. So public sector entities are funded by the government through the taxpayers' money. So funded by the government through the taxpayers' money, They are funded by the government through the taxpayers' money, Then in this case, these other ones are funded by the owners or the shareholders. These ones are funded by the owners. They are funded by the owners or the shareholders. So they are funded by the owners or the shareholders. Then accountability. To whom are they accountable? So accountability. So in the perspective of accountability, they are accountable to the members of the public. So public sector entities, they are accountable to the members of the public. Then they are accountable. These ones, private sector entities, are actually accountable to the owners. They're actually accountable to the owners or shareholders. Accountable to the owners or the shareholders. Accountable to the owners or the shareholders. Those are part of the key difference of what happens, for example, in public sector entities and of course what private sector entities. So these ones, they'll be so much profit focused. These ones, they'll be focusing on what? Providing essential services to the citizens. Then in this case, when you talk about, in this case, ownership, they are owned by the government. Then of course, still the same time, they are funded by the government through what? The taxpayers' money. So each and every year you've heard that in this case, the government is allocating money for what? For education. Part of it, in this case, will be able to, for example, in this case, do what? Enable. So I can be able to see someone is saying, is not able to hear me again. Is not able to hear me again. That is T. I can see Gitonga says I'm clear. So I don't know. I don't know what could be the issue. Gitonga says I'm clear. Ikosawa, you are clear. You are clear. So those are the differences. So if someone asks you the difference between the two, you can be able to indicate that. You can be able to indicate that. So we've been able to say that when these public sector entities are preparing their books of accounts, they adapt what we call what? The International Public Sector Accounting Standards. So that is the framework. It will be able to guide. For example, if you're working in, for example, where? In maybe a school as a bazaar. What should be able to guide you when you're preparing the books of accounts of that school? It is what? IPSAS. That is what? The framework. So why is it important that those who are working in the public sector as accountants, or for example, in this case, in matters finance, they should be able to adapt IPSAS. So you can look at the importance of adapting IPSAS. Importance of adapting IPSAS in, for example, preparing these what? Financial statements. The importance of adapting IPSAS. The importance of adapting IPSAS. The importance of adapting IPSAS. Importance of adapting IPSAS. Importance of adapting IPSAS. So the importance of adapting IPSAS. Why is it important they adapt this particular framework? So some of them, I think you know about them. For example, it will bring about what? Uniformity. For example, in this case, improve, for example, what we call what? Consistency. The books of accounts for this year will be consistent with those ones for next year. So you can do an easy comparison because there's a framework having to be followed. So it can improve accountability, improves accountability and transparency. That is one of the benefits. Accountability and transparency. Improves accountability and transparency. So it will be it basically enhances accountability because they'll account by using what? The IPSAS. So they'll, for example, in this case, be answerable to the members of the public, what they're having to do in terms of what? The finances. Then it improves reliability, improves the reliability of the accounts. It improves the reliability of the accounts of public sector entities. It makes them become reliable. So you can, for example, look at them and, for example, be able to make an informed what? Decision regarding, for example, how much should actually be used to fund this kind of what? Entities. Then another thing, it enhances comparability. Enhances comparability amongst government agencies. Enhances comparability amongst what? Government agencies. Then it can help improve efficiency. Improves consistency. It improves consistency in preparing and reporting of financial statements reporting of financial statements, financial what? Statements. Then another thing it will be able to help, it will make it very easy, for example, to undertake what? An audit. So you are told, for example, in this case, these public sector entities are audited by the office of what? Of the Auditor General. The office of the Auditor General is the one that actually audits them. So it'll be very easy for the office of the Auditor General, for example, if they adapt this framework, because they'll be able to know, for example, how these accounts or the amounts presented in these financial statements were realized or they came about. So it'll be very easy to be able to do what? Audit. It improves audit of what? Public entities. It improves on the audits, improves on the audits of public sector entities, improves on the audit of public sector what? Entities, improves on the audit of public sector entities. But of course, this adaptation of these IPSAs will come with its own what? Challenges. It will come with its own challenges. So there'll be some challenges regarding what? Adapting this kind of IPSAs. Remember, for example, some of the countries are sovereign. So they might have come up with what? Their own laws and actually what? Regulations, which of course now in this case will inhibit, for example, adaptation of what? Of the IPSAs. It can become a challenge because different countries have different laws and regulations or what? Reporting framework. So challenges of adaptation. What are the challenges? Challenges of adapting. What are the challenges of adapting international public sector accounting what? Standards. What are the challenges that would arise regarding adapting what? International public sector accounting what? Standards. So challenge number one, sovereignty of different countries or independence, sovereignty of different countries. Different countries have their own ways of doing their own things. Remember, they are international. So they are international. But now in this case, you find that each and every country is sovereign. There's a way they do their own things, which in this case might not actually end up having to match with what, for example, the IPSAS has been able to prepare as a standard to be adapted. So it means that this sovereignty will hamper the adaptation of what? These IPSAs. So i.e. countries prefer using, some countries prefer using local standards, They might have their own local standards that they have been able to prepare. So it can be a challenge to adapt what? The IPSAs. Number two, different countries have different reporting requirements. Different countries have different reporting requirements. So that could be part of also the challenge. So the reporting requirements might not actually be in conformity of what? Of the IPSAs or what the IPSAs provides. So these different requirements regarding how countries are supposed to prepare their books of accounts poses a challenge in adapting what? IPSAs. So unapata kila country iko their way as to how they want, for example, their government agencies to report. And of course, IPSAS has been able to prepare the standards. But what the countries want doesn't, for example, match with what IPSAS has actually been able to do, what to provide. So it basically brings upon a clash. It becomes very difficult, for example, in this case, to do what? For example, to adapt them. Then another thing, countries have different laws and regulations. Countries have different laws and regulations. Countries have different laws and regulations. And another challenge could be lack of resources to implement, systems, systems to implement IPSAS, and systems to implement IPSAS. So some of these standards, they require resources, for example, training the employees or training capacity for the employees. So if you don't train them or you come up with the proper, for example, accounting systems that can, for example, utilize IPSAs, it will become what? A challenge. Then the very, very last one, there can be lack of what? Political goodwill. So some countries, there can be lack of political goodwill, by some countries, So some countries, they don't have that political goodwill. So for example, in this case, they adapt what IPSAs in reporting. So it can become a challenge whereby, for example, they don't want to adapt them because they want, for example, to use the loopholes of not having to adapt so that they can be involved in what? Corruption. They can be involved in what? Corruption. You know, that is what happens in government, for example. So they don't want, for example, to follow the framework because the framework, for example, will enhance what? Transparency. I think it will enhance transparency. So they don't want this transparency to be there so that those ones in the political sphere can be involved in what? Corruption. So they might end up not having to be able to do what? Adapt them. So there'll be lack of what? Political goodwill. And therefore it will pose a challenge in adapting these particular standards, standards. So that is, those are basically part of the importance and of course challenges that might end up having to arise whenever, for example, IPSAs are having to be adapted. So of course, in your financial accounting, you are able to do the introduction public sector accounting. For example, in this case, you looked at what we call the paymaster general account, the appropriations and aid account, the general account of what's, then in this case, the appropriation account. You must have done it in your financial accounting. So our case will so much focus on, for example, what comes to us the tail end of the process in terms of what, for example, preparing what? The financial statements. So now in this case, we can be able to look at preparing the financial statements, look at the preparation of the financial statements for public sector entities. And of course, there are just a few things, for example, on what you learned in your financial accounting. There are a few things in this case you must be able to build up on what you learned in your financial accounting. There are a few things you must build up in what you learned in the financial accounting. So there are some terms that are actually a bit different. That in this case, we use different terms. For example, when you're preparing books of accounts for public sector entities, when you compare to the other entities. For example, in this case, in the other entities, the resources utilized, for example, to set up the business, we've actually been referring to them as what? As capital. But now in public sector accounting, we refer to this one as what? As the accumulated fund. In the normal preparation of the financial statements for the other entities, we're referring to, for example, what has been realized between the difference between the incomes and the expenses as what? As a net profit. But now in this case, in the government agencies or public sector entities, a profit will be able to refer to it as what? As a surplus. And in this case, what we've been referring to as, for example, in this case, a loss, we don't refer to it as a loss in public sector accounting, but we refer to it as what? As a deficit. So you must be able to, in this case, for example, know part of the different terminologies that in this case will end up having to come what? Across. So we can look at the terminologies. So the different terminologies, which will be very common. So of course there are others, but these ones will likely be very common. Different terminologies in accounting for public sector entities. Different terminologies in accounting for public sector entities. For example, the most common ones we are going to come across. In this case, we have what we are calling what? Capital. We will refer to it as, capital is known as an accumulated fund, So they accumulated a fund, so we don't refer to it as what? As capital. In this case, profit is known as a surplus. And in this case, a loss is known as a deficit. is actually known as a deficit. Is actually known as a deficit. Is actually known as a deficit. So we'll almost basically use the same concepts regarding when you are preparing, for example, the income statement. We use the same concept whereby you get the incomes for that government agency, you less the expenses for that government agency. It will be able to give you either a surplus or what? A deficit. Then in this case, the capital or the amount that was, for example, in this case, utilized to fund will be known as what? As the accumulated fund. When you are preparing what? The statement of financial what? Position. Statement of what? Financial position. So we can look at a question. We can be able to look at a question very fast. Very fast, you can be able to look at a question and see how eventually, for example, you can come up with what? These statements. So I want you to open September 2015, question number 5B. Please open September 2015, question number 5B. Please inform once you've been able to open that question, because I want us to look at that one. Start looking at how you prepare the financial statements for what? For public sector entities. Let me know whether you've been able to get it. I had shared a bunch of past papers. I think you must have been able to see them. You must have been able to see them. September 2015, question number 5B. So you can open it as I also open mine here. Let's see whether I can be able to open it. So let me know whether you've been able to open it. Let me know whether you've been able to open it. So September 2015, question number 5B. September 2015, question number 5B. Found it is actually on page number 30. So I think our friend has been able to tell us where it is. It is on page number 30. So Betty, have you found it? So the other should be able to confirm on page number 30. Yeah, it is on page number 30. So a number of you should be able to confirm whether we are there. Justin got it. Justin got it. Justin ameipata. 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 Justin ameipata. Justin ameiwai. Justin ameiwai. September 2015, question number 5B. Question number 5B. So we are able to get it. So I'm assuming you've been able to get it. I'm assuming you've been able to get it. So go to confirm. So the question, we can go through the question. Make sure that in this case, when you come to the class, you have the past papers. You can print them. You can print them. You'll be working with them. You can print them. It will be very easy. It will be very easy when you print them. So it says the following was extracted from the books of the Ministry of Tourism for the fiscal year ended 30th of June 2015. So you have an accumulated fund. That would be able to say it is what is capital. Cash and cash equivalents. So that is money they had. Receivables is an asset. Inventory of consumables, an asset. Transfers from exchequer, I think that is part of the incomes they received. Fees and fines and licenses, that is an income because they were charging fines and licenses, maybe to hotels or something. So there's an income they realized. Liability for long-term benefits, that is a long-term liability. Long-term borrowing, a long-term liability. Finance cost, so that is part of the expenses here. Supplies and consumables used, so that is an expense. Wages and salaries expense, other expenses. Transfers from other ministries, transfers to other ministries, that is outgoing amounts, that is an expense. Computer equipment, that is an asset. Vehicles, an asset. Land and buildings, an asset. Revenue from exchange transactions, that is an income. Revenues, income. Payables, that is a liability. Reserves is part of the capital. So the first question, in this case, what was performance for the year ended 30th of June 2015? The statement of financial position as at 30th June 2015. So the statement of financial performance here simply means you get what? The income. But in this case, the Ministry of Tourism. So Ministry of Tourism, Ministry of Tourism, Ministry of Tourism. Statement is the statement of financial performance. Statement of financial performance. Statement of financial performance. Statement of financial performance for the year ended. For year ended. Year ended 30th of June 2015. 30th June 2015. 30th June 2015. So in this case, so we'll be able to have our shillings having to be in thousands. Our shillings having to be in thousands. Then in this, we have the receipts. Be able to refer to them as what they received. The receipts, remember, they're not carrying out any profit making business activity. So they were having what the receipts. So if you look at, in this case, the our information there. So you have accumulated fund, cash and cash equivalents, receivables, inventory and consumables. So the first one there is transfer from the exchequer. That is the money they received. What they mean by transfers from the exchequer is money from treasury. Remember, government agencies were saying they are owned by what? By the government. So they are funded by the treasury. So from the exchequer, maybe this money was wired in their bank account to fund or run the Ministry of Tourism what activities. From where? The treasury. So that is part of what? The receipts. So you have the transfers from the exchequer. So transfers from the exchequer. Transfers from the exchequer. Transfers from the exchequer. So that was how much? 1875,000. 1875,000. Then you have, in this case, fees, fines, and licenses. So they charged those who are involved in the Ministry of Tourism some fees, fines, and licenses. Maybe they were hotels. We normally have, is it the hotel levy or something? So it's like those ones. So it'll be part of what? Their receipts. It'll be part of what? Their receipts. So that was how much? 375,000. 375,000. Then in this case, we have liability for long-term benefits. That is not any long-term borrowing, not an income, a receipt. Finance cost, not a receipt. Supplies, other transfers from other ministries. You have transfers from other ministries. So transfers from other ministries. Transfers from other ministries, it was how much in this case? It was transfers from other ministries. It was 375,000. So still the same case. 375 or 37,500. So 37,500 is actually 37,500,000. Then transfers to other ministries. That is what they spend out. Revenue from exchange transactions. Revenue from exchange transactions. Revenue from exchange transactions. So that was, in this case, 75,000. 75,000. Then what else? Other revenue. We have other revenue. So other revenue. Other revenues. Other revenues was, in this case, 450,000. 450,000. 450,000. 450,000. 450,000. What are you getting as the total here? as the total there. So those are the only what revenues. What are you getting as the total there? As the total there. What are you getting as the total there? So I can see 2,812,500. So 2,812,500. That is from Hope. But now this particular ministry incurred somewhat expenses. It incurred somewhat expenses. So in this case, they had what we call what expenditure. Expenditure. What was the expenditures in this case? The expenditures in this case, for example, the first one in this case, you can be able to see up there. We have finance costs. Finance costs. The finance cost in this case was, is it 75,000? Yes, 75,000. 75,000. So this one you'll less, you'll end up having to less. Then what else? Supplies and consumables used. So they had some supplies and actually consumables used. Supplies and consumables Supplies and consumables used. So that was in this case, supplies and consumables used was actually 300,000. So 300,000. So this one you still less. Then wages and salaries. So walipa salo, walipa watu salo, walilipa watu salo. So wages and salaries. That was actually in this case 750,000. So still actually less here. 750,000, you'll be able to less. 750,000, you less. Then we have other expenses. That is 900,000. We have other expenses. That is how much? 900. How? Other expenses 900,000. You feel less as an expenditure. Then you have transfers to other ministries. So the incurred money which they transfer to other ministries. Maybe it's also in this case, it'll end up to which ministry? Maybe Ile Duale. Is it defense? Ile Duale defense. It can be that one for Duale defense. So transfers to other ministries. Transfers to other ministries. So that was how much? 375,000. 375,000. Still an expenditure they incurred. 375,000. So if we go down there, computer an asset, vehicles an asset, land an asset, revenue, no. So there's no any other, for example, expenditure. So what is the difference? The difference should be able to give us either in this case a surplus or a deficit. Remember tumesema huko hatutumii nini net profit ama sijui loss. Huku lugha tunatumia ni surplus or deficit. So what is the difference? I can see Hope says 412,500. Is it true? It is other revenues. Sorry, I'll improve on my handwriting. Other revenues. I will improve on it. So other revenues. So other revenues. That is other revenues. I can see Mumbi 412,500. Is it true? So Betty, you are not saying anything. So let me assume it's correct. 412,500. Which now in this case, is it a surplus or a deficit? In this case, is it a surplus or a deficit? It is a surplus because it is what? It is a positive. If it was a negative, it would have been a deficit. It would have been a deficit. It is actually a surplus. It is actually what? A surplus. So the second part of the question wanted us in this case to prepare the statement of financial position. So we can look at in this case, Ministry of Tourism, statement of financial what? Position. Ministry of Tourism, statement of financial 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 position. Statement of financial position as at 30th of June, that is 2015. That is 30th of June 2015. And of course, as per the normal procedure of preparing what a statement of financial position, you start with what? Non-current assets. Non-current assets. So we'll start with the non-current assets. Non-current assets and current assets. Remember, our shillings are actually in thousands. Our shillings are actually what? In thousands. So the non-current asset, in this case, we have down there. If you can be able to go down there, you can be able to see, in this case, computer equipment. You can be able to see computer equipment. It is of how much? It is of 200,000. Then in this case, we have vehicles. We have vehicles, 175,000. Vehicles, 175,000. And then in this case, we have land and buildings. Land and buildings of how much? In this case, land and buildings of 2,625,000. 2,625,000. 2,625,000. So I think those are the only non-current assets. Then in this case, you have the current assets. For the current assets, if you look at the start of that particular information extracted from the books, we have cash and cash what? Equivalents, which was what? 375,000. So cash and cash equivalents. Cash and cash equivalents. So the cash they had, and of course, those assets, they can be able to convert into cash very easily. They were 375,000. 375,000. Then we have receivables. Receivables. In this case, it was 150,000. 150,000. Just from the information we've been given. Inventory of consumables. Inventory of consumables. So that was how much? 75,000. 75,000. I think those are the only ones. The others are not. So receivables, inventory of consumables. I think that those are the only ones. So in this case, you'll be able to get what? The total assets. So the total assets. What is the figure you are getting for the total assets? The figure you are getting for the total assets. What is the figure you are getting for the total assets? So this one is land and buildings. The figure you're getting for the total assets. I can see you are saying 3.6 million. Betty. Betty is here. Wow. 3.6 million. So Betty has been able to give us that one. So those are what? The total non-current assets plus the current assets, you get the total assets. Now you go to the other side of, remember in this case, you've been able to say it is not capital, but you refer to it as what? Accumulated fund. So in this case, you'll be able to say, you continue, you say accumulated fund. Accumulated and liabilities. Accumulated fund and liabilities. So you go to that side. So our accumulated fund, you would be given up there. You can see it is 562,500. 562,500. So accumulated fund. It is the first item you can see in that extract. Accumulated fund is actually 562,000. 562,500. Then remember, we had what? the surplus. We had what? The surplus. Remember the surplus? The surplus we got. The surplus. It was how much? The surplus we got was how much? The surplus we got was how much? The surplus from, in this case, the statement of financial performance. The surplus from the statement of financial performance. The surplus from the statement of financial performance ilikuwa ngapi? I can see Mumbi says 412, 500. So 412, 500. So we'll add, but if it was a deficit, we would have lessened. Less, but if it was a surplus, we'll be able to add. Then, of course, also in that extract, the last item, you've been told there were some reserves. Reserves. There were somewhat reserves. There were somewhat reserves. So we'll have reserves. The reserves were for 1350,000. 1350 what? 1,000. 1350,000. The reserves were for 1350 what? 1,000. 1350,000. So they were for 1350 what? 1,000. Then continue with the statement of financial performance. Indicate usianze kuchora line tena uweke kando. You just continue with it. Just continue with it because me I cannot continue writing down here. So that's why I'm moving here. So in this case, we have non-current liabilities. Non-current liabilities. Non-current liabilities. Non-current liabilities. If you look at that extract, we had actually been told that we have liability for long-term benefits. Liability for what? Long-term benefits. Liability for long-term benefits. Liability for long-term benefits. I think it's liability for long-term benefits. It is 150,000. 150,000. Then just down under it, we have long-term borrowing. Long-term borrowing. We have long-term borrowing, which is how much? 750,000. 750 what? 1,000. Then which other one? Which other one do we have? I think they are the only ones. They are the only ones. Then in this case, now we have what? Current liabilities. Current liabilities. The current liabilities. The current liabilities. The current liabilities. So which current liability we have? I think we have only what? Payables. We have only payables, which was 375,000. So payables 375,000. So in an exam scenario, make sure you've been able to utilize all the information. So probably in this case, what you'll be doing, you might end up having to, for example, you'll be taking the past paper. You'll be taking the past paper to see what in this case go to collect all the information. So I think that is the only item that is actually remaining that you haven't utilized. So so what is the total you're having to get? What is the total you're having to get, Betty? Not visible at the surplus. This one is 562, 500, 412, 500. This is 1,350,000. 1,350,000. 1,350,000. You can see T says 3.6, won't be 3.6. Is it 3.6? Yes, I think it is actually 3.6. So 3.6. And of course, that is basically the end of that. That is the particular statement. In this case, you end up having to This says my voice is breaking. My voice is breaking. My voice is breaking. What about right now? So what about right now? What about right now? What about right now? Is it still breaking? It is good now. It is good now. It is good now. So so we'll end the class there. So I'm going to leave a question. We'll be able to look at it in our next class. in our next class. But of course, you can be able to attempt this one. There's another area we look at on budgeting, but I can leave this one as an assignment. This one as an assignment. You can look at these questions. Look at November 2015 question number 4A and May 2015. So November 2015. So assignments. So November 2015 question number 4A. Then also look at May. Is it May? May 2015 question number 3A. It is May. I think it is May 2015 question number 3A. Question number 3A. Look at those ones as what? As an assignment regarding how you can be able to come up with these final statements. But now in the next class, we'll be able to look at how budgeting is done and how in this case variances are actually what? Realized. So we can end there for now. So in the next class, we'll be able to show you how now in this case they do budgeting, and of course they compare with the estimates. They compare the estimates with, for example, what was actually spent. They realize what you're calling what the variances, and of course now in this case how we determine what the variances. So we can end there for now. So let's catch up. Let's meet in our next class. Unless there's a burning question, then let's end there for now. Let's end there for now. So we'll be able to wind up with public sector accounting in our next class. Then we start looking at another area. Any question? Any question you might be having? Any question you might be having? Any question you might be having? So if there isn't any question, then I wish all of you a good night. So let's catch up in the next class. Asanteni sana. Asanteni sana. So by when should we be finalizing the coursework? So estimated time, maybe 3 weeks before exam or 2 weeks before exam. So you can do the math. Estimated time, 2 weeks before exam or 3 weeks before exam. So we'll try our level best at our end. So we'll finish the syllabus. Any other question? Any other question? I can see Hope says Leo ameelewa. So Leo ameelewa. Leo ameelewa what you've learned. Okay. Any other question? Any other question? If there isn't, then I think let's end there. So let's catch up in the next class.